This guy right here, that's me at 18 years old. Fresh out of school, I just spent years learning history, science, and even memorizing that. But ask me about investing, and inside my head, it was like this: nothing. We literally learned zero about money at school. And yet, what if I told you that not investing costs you hundreds of thousands over your lifetime? That's exactly why I'm going to share everything I've learned the hard way so you don't have to. And to make it easier, I'll rank each type of investment from 1 to 5 for both risk and return so you can figure out what actually fits you. Oh, and quick disclaimer, this isn't financial advice, just a breakdown of my own experience. If you're stacking cash in a regular savings account because that's what everyone told you to do, congratulations. You just signed up to stay broke for the rest of your life. The problem? If your money's growing slower than inflation, well, it's not growing, it's shrinking. Inflation has been cruising at around 2.85% per year over the last decade. So if you're only getting 1%, your buying power is slowly melting away, just like an ice cream on a summer day. Instead, look for high-interest savings accounts. They are like regular savings accounts with the same level of safety, but with extra caffeine. On the risk scale, this is by far the lowest risk option for growing your money with a 1 out of 5. Ally Bank or Citibank can offer rates as high as 3.8%. The bigger it is, the better it is. And don't take this out of context. If you're allergic to risk, this is your safe zone. Though, let's be honest, it only has high in the name. It's not exactly going to skyrocket your money with this one. Think of it as your emergency fund, something you can tap into when things go sideways without having to sell your investments, all while making sure your money doesn't lose its value to inflation. Let's put it in perspective. If you had put $1,000 into a high-interest savings account with a 3.5% annual return back in 2015, you'd have around $1,410 in 2025. Not exactly life-changing, but at least you're not losing money because of inflation. So in terms of returns, this would be about a 1 out of 5. Gold is one of the oldest and most trusted forms of wealth preservation. It's been around for thousands of years, long before people started trading imaginary internet coins and buying pictures of monkeys in sunglasses. It's what I'd call a 2 out of 5 on the risk scale. Not as safe as a savings account, but a lot less wild than crypto. It tends to shine when the world's falling apart, but if you're looking to grow your wealth, it's not exactly the best option. For a bit of perspective, if you'd put $1,000 into gold back in 2015, you'd have around $1,737 in 2025. Not too bad, but now compare that to stocks, and you're basically bringing a butter knife to a sword fight. If you want to invest in gold, don't worry. You don't have to go out and buy physical gold bars. Platforms like Interactive Brokers or Trading 212 let you invest in gold in 3 clicks. Just sign up, then look for a popular gold ETF like SPDR Gold Shares or iShares Gold Trust. These are basically bundles of assets that you can buy and sell like a regular stock. Pretty easy, and you won't need to worry about finding a place to stash a 20-pound gold bar. Ever mention to your family that you're thinking of investing in the stock market? And suddenly it's like you just said you're jumping out of a plane without a parachute. Sounds familiar again? I know. But is it really that dangerous, or is this just one of those old myths? Let's demystify this. First, let's quickly break it down. When you invest in the stock market, you're basically buying tiny slices of real companies. Apple, Amazon, Coca-Cola, you got it. If they grow, your investment grows. If they flop, well, you'll learn a valuable lesson. But unlike your savings account that grows like a sleepy snail, stocks move in waves. One day your portfolio is up 5% and you're feeling like the Wolf of Wall Street. The next, it's down 3% and you're questioning all your life choices. That's called volatility. And yes, it's scary, but it's also completely normal. For example, if you had invested $1,000 in Apple back in 2015, you'd have about $5,400 in 2025, a massive 440% return. Not bad, right? But if you had put that same $1,000 into a company like Bed Bath & Beyond, you'd be looking at a 90% loss instead. But if you zoom zoom out and look at the bigger picture, the stock market has historically delivered impressive returns for patient investors. It's like hiking through the mountains. There are a lot of ups and downs, but you're still going higher overall. So what's the secret to not crashing and burning? Diversification. Don't go all in on that one company you like. Spread across different sectors. That way, if one stock dives, others might carry you up. Still sounds stressful? Hang tight, I'll show you an easier option in a minute. But for now, stock picking gets a 3 out of 5 on the risk scale. It's not as complicated as it might seem, but you'll need to do a bit of homework to understand the basics and fundamentals of the companies you're investing in and develop a strategy that doesn't involve taking random decisions. As for returns, it really depends on your strategy and the portfolio you build. The less successful ones might average around 6%, while the best can hit 12% or even higher. And some companies even pay dividends, which are regular cash payments for being a loyal shareholder, meaning you get a piece of their profits just for holding the stock. This is pure passive income. So that's a solid 4 out of 5 for the returns. Now, if you want to buy stocks, it's actually pretty easy. All you need is a brokerage account, and with as little as $100, you can start buying shares. Platforms like Interactive Brokers or Trading 212 make it super easy. Create an account, fund it, and you're ready to go. Just maybe don't mention it at dinner again, unless you like drama. Okay, so you want to invest, but the idea of picking stocks makes you sweat? I got you. To keep things simple, you can invest in an ETF, short for Exchange Traded Fund. Think of it like a big basket of companies you can buy in one shot. Instead of picking 1 or 2 individual stocks and praying they don't crash next week, an ETF lets you spread your money across hundreds of companies at once. It's like going to a buffet instead of ordering one risky dish. You get a little bit of everything, which means less risk if one part of the market goes sideways. There are many ETFs available. You can pick one that tracks the S&P 500, giving you a slice of the 500 largest companies in the US. Or if you're feeling international, go for a world ETF with over 1,600 global giants inside. And unless every major company on Earth collapses simultaneously, your money's in good hands. And if that ever happens, well, we've probably got bigger problems than just our portfolios. As for the returns, if you had invested $1,000 in an ETF for 10 years with an average 8% annual return, you'd have around $2,159, more than double your initial investment. So I'd give it a solid 3 out of 5. With an ETF that tracks the S&P 500, you can typically expect around 8 to 10% per year, making it a solid choice for long-term growth. Just one thing, check the fees. Unlike individual stocks, ETFs have management fees. And even if they can seem small, they can really eat into your returns over time. So double check before you commit. So an ETF is the perfect low maintenance way to invest to build wealth long term. No constant monitoring, no stock picking anxiety. You buy one ETF and you're instantly diversified. Probably one of the oldest and most trusted forms of investing, because unlike stocks or crypto, real estate is concrete. You can see it, touch it, live in it, and it taps into something primal, shelter. And as a bonus, property values tend to appreciate over time. But before you write off real estate as too complicated or expensive, in a minute, I'm going to show you a way to invest in real estate without all the headaches. But first, let's talk about leverage. Real estate is one of the few places where the bank lets you use their money to buy your investment. For example, if you've got $20,000 for a down payment, you might be able to snag a $200,000 property with a mortgage. Then you rent it out and your tenants pay your loan while you pocket some rent money. Sounds like passive income, right? Well, sort of. Because with great property comes great responsibility. The boiler that decided to give up the ghost, or that tenant who never pays on time.
Give me rent. You'll get your rent when you fix this damn door!
Yeah, that's all on you. And unlike stocks, you can't just click sell and walk away. Selling a house can take months or even years. So I'd give real estate a 2 out of 5 on both risk and returns. Now, if all that sounds like too much stress, let me introduce you to Real Estate Investment Trust. It's basically a fancy way of saying that you invest in companies that own a bunch of properties. Think of it as the Airbnb of real estate investing, but you never have to deal with guests or renovations. However, returns are usually a bit lower than owning property directly. So again, it's a 2 out of 5 for both risk and returns. Starting with REITs is super easy. All you need is a brokerage account, the same one you'd use for buying stocks or ETFs. So if you want to invest in real estate without the hassles of property management, it might be the perfect solution. Before we get into an investment that almost no one talks about, let's take a look at one of the most exciting and occasionally terrifying ways to grow your money. Yep, crypto. Unless you've been living in a cave, you've probably heard of Bitcoin, the king of crypto. And if you had invested $1,000 in Bitcoin back in 2015, it would be worth around $260,000 in 2025. That's literally crazy. But hold on, it's not all sunshine and Lambos. If you'd bought Bitcoin at its peak in 2017, you'd have watched your investment drop by over 80% within a year. And it's not just Bitcoin. There's Ethereum, BNB, and approximately 23,472 other coins. If you're willing to take on a bit more risk, putting a small portion of your capital into crypto can really boost your portfolio's growth potential. But remember, this is the wild west of finance, so it's definitely not for the faint-hearted. I'd give this a 5 out of 5 on the risk scale and 5 out of 5 on return as well. To get started, you'll need a digital wallet. Think of it like a bank account for your coins. Since security is a big concern with crypto, stick to well-established platforms like Binance, Coinbase, or Kraken. Once you're set up, you can start buying crypto. But maybe don't go all in on Trust Me Bro coin. Just saying. If you were born in the 90s, chances are you owned a binder full of Pokemon cards. Now, what if I told you that a perfect condition Pikachu card sold for $5 million? I think you see where I'm going with this. But before you sprint to your attic looking for that old binder, let's talk about the most exotic and unpredictable ways to invest your money with the collectibles. Whether it's fine wine, high-end watches, classic cars, or even limited edition sneakers, these items tend to skyrocket in value over time if they're well preserved. But, and this is a big but, this market is extremely speculative. The value of these items is often based on rarity, hype, and trends, which can shift overnight. To really profit from collectibles, you need 3 things: knowledge of your niche, good instincts for spotting what holds value, and patience. I'd rate this a 4 out of 5 on the risk because the market can be extremely volatile, and the return will really depend on the market you're into. So if you're passionate about a niche market and willing to take some risks, collectibles might be a fun way to diversify your portfolio, but don't buy something just because TikTok says it's the next big thing. Buy it because you actually like it. That way, if it tanks, at least you're stuck with something that sparks joy. Otherwise, well, you'll be the proud owner of a living room full of sealed Star Wars figurines and a partner silently questioning every life decision you've ever made. All right, if you made it this far, congratulations. You now know more about investing than 90% of people. But before you click away, let me leave you with one last piece of advice. Time is your biggest asset. The earlier you start, the more your money starts to compound. In other words, it's the snowball effect where your investments start earning returns on their returns. Now, let's be real. Investing a few bucks a month won't make you rich in 10 years, but give it 40 years, and even with small amounts, it can change your life. But here's the thing, if you want that snowball to grow faster, the solution is simple: invest more. And that's exactly why I created this channel. If you learn how to generate income online and invest that money smartly, your freedom isn't a dream anymore. So if you're ready to take that first step, click on this video and I'll show you simple business ideas you can start now.